Today we're going to look a little bit more closely to the idea of shareholder decision making. We're continuing this discussion, as I said, about where do you draw the line of responsibility between the board and the shareholders, trying to understand the functioning of corporate structures, and this is the background to understanding the director's duty. What we're talking about on a daily basis here in this class is stuff that are on a daily basis the subject of discussions in the financial press. We've already talked about, to a degree, about the structure and composition of the board. So why would we want to have different structures in the board? English law allows the shareholders to decide for themselves who sits on the board and what division of responsibility they have within that board. That is something that is expressed through the articles of association of the company, but is also expressed through the decisions that the board makes itself. This is not mandated by law. An appreciation of the dividing lines in the information that you find in the Companies Act. On the one hand, you have a lot of stuff that are default provisions that will apply unless the parties have decided to do something else. How do they decide to do something else? They put it in the Articles of Association. A large part of the provisions in the Companies Act allows you to do this. It says if they want to do something, fine. If they haven't decided or they don't know, this is the default provision if it comes up. Some other provisions, however, are mandatory, meaning that no matter what people want to do, even if everybody agrees and everybody's happy, you're still not allowed to do it because there are certain things that the legislator has decided need to be done in the same way by everybody because they serve a wider public interest. It is crucial, every provision in the Companies Act that we come across, for you guys to be aware whether this is a mandatory provision or whether this is a default provision that allows. And it isn't really that difficult, you just have to read what the provision says. The provisions tell you exactly what is meant to happen. The problem is that sometimes they're written in language that is not immediately obvious and not easy to understand. That's why if you don't understand the statutory provision, read your textbook, but don't just read the interpretation of the textbook without looking at the provision. Coming back to structure and composition of the board, this comes under the default bits of the legislation. So we don't have mandated structures. In other countries, however, in Germany, that's a common example, they do have multiple tier boards that have got representation of different groups. One part of the group is directors with an executive committee. Another part of the board are representatives of the employees. Another part of the board are directors with a non-executive capacity. And all this comes together by law. So every company of a specific size needs to have these people represented adequately within the board. In the UK, you got nothing. But you do have one thing, you have a division between executive and non-executive position. Now we're talking about public companies, the ones that are listed in the stock market. So for those public companies that are listed in the London Stock Exchange, you have the UK Corporate Governance Code, and you got something else called the Stewardship Code. These documents are sets of best practice rules that inform the company and inform the board how to appropriately do things. These offer you some structure for the board. So you could argue, because of all these tools that we have available now, because all of this advice that getting through the formalized channels, because the London Stock Exchange is a recognized body, so it's not and what they create is not the law, but their rules are meant for their members. And there is last week they comply with the code, then you need to make disclosures to your own shareholders as to why you're complying and in which ways you're not complying and what you're doing. These codes mandate that in public listed, we've got a balance between non-executive directors. Now, what is this idea of the non-executive directors? This comes from an attempt to address a series of corporate failures. If the company is fully run by management functions, they could be sucked into the everyday running of the corporation, and they lose sight of wider strategic objectives. Also, if you've got executive managers who are paid to manage the company, so in addition to their position as director, they've got employment contracts that pay them a lot of money, maybe they are assessed to incentivize short-term behavior. If you're going through a cycle of annual re-election, I mean, this is not necessary for all companies, but for the majority of public companies, you've got like at the annual general meeting, you've got some sort of approval process for the board. So if you're an executive manager, you are subjected to this annual circle of re-election. Maybe you want to keep the shareholders happy. But keeping current shareholders happy isn't necessarily doing the right thing for the company, because the company is an entity that transcends its current shareholding. You have to think of the company as a perpetual structure. You need to think about future shareholders. The company is something that's larger, right? It's something that's meant to stay alive. So if you're thinking about your current shareholders, and if you're thinking about your current shareholders with an annual cycle of re-election, then maybe you're not doing the right thing. Maybe you're not investing in the long term because you're concerned about generating enough revenue to be able to pay dividends to keep people happy next year. If you're well-meaning, you're trying to do the right thing, but your perspective is quite narrow. It could be that you're not well-meaning. It could be that you're a director that enjoys a huge salary and enjoys a very successful job, and you like to see your face in the front page of the newspaper, so you're doing deals that are kind of profile enhancing, but in fact they're not good for the company because they're very risky, you take on a lot of debt, you're buying stuff at overvalue. Variety of reasons why you cannot let the executives run the show. What do you do instead? Well, the recommendation that's come out from a series of reviews and committees and processes. You've got, for instance, the Cadbury report that came out in 1992 that was addressing some corporate failures at the end of the 1980s. The recommendation that came from that was to create a separate part of the board with a supervisory role. So you got the executive guys that do the day-to-day running, but you've got another group, the non-executive directors, that don't have a specific business to run on a daily basis, but can sit back and take a wider view of the company and help it in its strategic direction for the future. If you look at the idea of non-executive directors, you can look at things like the Cadbury review, you can look at the Higgs review, which came after the various failures in big corporations in the early 2000s. You can see why they recommended having a group of people who are focused on strategy, they're focused on performance, they keep an eye on risk, and also inputs a degree of variety on the board. Because you can have non-executive directors that are not the same, from the same background, from the same community, from the same gender and everything else as the executive director. So you can help to kind of broaden things up a bit so you get different perspectives, which is a healthier thing. If you look at the corporate governance code, it has a section on non-executive directors, and it says their role is that a unitary board, so we still have one board, but it's got like two different classes of people within it. They are to constructively challenge and help develop proposals on strategy and keep an eye on all these things that we mentioned, like risk exposure and all the rest of it. It is the nature of the beast that you will have repeat corporate failures, either at individual or systemic level, every few years, because this is tied into the cycle of the economy and so on. It is the nature of the system. You start off well, you're selling something that people want, you're making enough revenue. Slowly, the market gets saturated, so you need to come up with something else. It is the effort to come up with something else and to innovate that usually will lead you to taking riskier decisions, investing in stuff that might not work out, incurring too much debt, or if your profitability begins to drop, then you try to compensate with various ways that increase the risks. Clever corporations that are well run manage to find appropriate ways to balance those different risks and those different objectives so they survive in the future. Other corporations do not. This characteristic instability is more present in financial services and in banking than it is in retail trade. For the retail trade, you can probably see it coming. right? For a lot of the corporations that have failed recently, you can kind of tell that they were in a trade that was diminishing and it was not going particularly well. But for banking, because the pressure for profit and the opportunity for profit is higher, the assessment cycle is much shorter, so people get into riskier things much, much quicker and leads to trouble. All of these things, all of these reports, all of these inquiries, they come around every time something goes wrong. Part of their function is to give the message that if a problem is identified and fixed, things are going to be okay. Identified and fixed, things are going to be okay afterwards. Things will never be okay. There's a kind of cyclical instability built into the system. But what the reports do, every time they focus on something else that historically is going persistently wrong, and they're trying to do something about it. I'm not against the idea of commissions and reporting corporate failure, but I am against the idea of treating this particular commission and this particular report as curing the one thing that is wrong, because there isn't one thing that is wrong. You have to be well familiar with the UK Corporate Governance Code. Its latest version is from July 2018, but don't treat it as a solution or a sufficient solution to problems that we've had so far. See it as a dynamic document that is part of an ongoing process to deal with problems around corporate failure. This is the system that we're working with. Unfortunately, key component of the system is this instability. So frequent reports, frequent changes, an ongoing process of thinking what could we do to incentivize boards to behave in better ways. And as regards the non-executive directors, I do agree that it is a fantastic idea. And maybe the kind of continental approach of having dual-tier boards with set representations is making decision-making clunky and not very dynamic, and is not very conducive to innovation and so on. You know, that's the criticism of the European system. So this system is more dynamic. On the other hand, still, in reality, it doesn't really work, because the guys who become non-executives are exactly the same guys that are executives, that just become non-executives in another company. It hasn't really brought to the level of kind of looking at things from a distance and being able to contribute positively, and also bringing people in of a substantially different background. That it didn't do. But, you know, it was a good idea, and we're still working. Let's come back for a second to the idea of the role of the general meeting in relation to what the board of directors are doing. The directors are the ones that are running the show on the day-to-day management. If the shareholders are unhappy, or they disapprove, or they would rather something else be happening, there isn't a great deal that they can do about it. And the things that they can do about it are fairly drastic. If you're kind of vaguely disappointed, but you don't want to give the impression to everybody that you think the company sucks, then maybe you can wait to the next annual general meeting and kind of vote against some stuff just to demonstrate your dissatisfaction. If you're in a public company that is obligated to put an executive remuneration package for a vote at the general meeting, then you can vote against that. And that's a kind of roundabout way of saying we don't like you guys. But if the board is doing stuff that you seriously disapprove of, then you can use section 168 and remove the board. That is dangerous. It sends the wrong message to the market. It demonstrates to everybody that your company is suffering from some significant dysfunction. It is within your power to do as a shareholder, but it's not something that you will do lightly. The general meeting remains the core decision-making body, and it is, in theory, the source of its power. If the board does a runner, so they're not there to make decisions, or they're completely in disagreement with each other and they cannot decide what to do about anything, then the residual power of the general meeting can allow it to take charge. You got cases, for instance, like Massey and Wales, that demonstrate how when there's a real block and there is no adequate mechanism in the Articles of Association to break through a disagreement at the board, then the general meeting can assume some management role till the problem is resolved. So the general meeting does have residual powers to act, and the board asks the general meeting if they want to. So the board can put a question to a general meeting for them to make a decision as to how they should proceed in an issue that might be controversial or might have significant consequences for the company. Now, not having to ask them is not the same as You cannot ask. You can ask them stuff if they want to, either informally or formally through the general meeting. And an example of a case where this has happened is the case of Bamford from 1970. Also, you got a series of things that we will see when we talk about directors' duties that might on their own not be a violation of some rule, but it is subject to the general meeting to approve them. So something that the director would not be entitled to do as a matter of law, it can be superseded by agreement from the general meeting. You can agree to give them a loan, for instance, or you can agree to excuse some conflict of interest. These are things that can be done. You can have an unanimous agreement by the shareholders to do certain stuff, but that doesn't happen very often. You can look at the case of Express Engineering as an example. But when we're talking about the totality of the company mandating some action, then this is all of them, not just the people who happen to be at the meeting. This is like every registered shareholder needs to agree to do something. And of course, that's possible in the same way that they would have the power, if there were that many of them, to change the Articles of Association. The crucial is this list here, where the board has to go back to the general meeting and ask them for stuff. Dividing line between the power of the board and the opportunity or the necessity of the general meeting to intervene. If you have a desire to change the Articles of Association or change the type of incorporation, you have to do this through the general meeting. This is not one of the powers of the board. If you want to issue additional shares or the company wishes to repurchase some of the shares, again, this is not something that can be done without GM approval. If we're talking about rights, only you need general meeting approval, but as the specific authorization of within the class. Knowing about all this gives you some opportunities to play around with the rules to achieve outcomes that might not look that achievable when you're starting off with. If you have somebody that wants to join a company and wants to achieve certain things, they want to become director for life, they want to be secured in their position, perhaps if they're a minority so nobody can remove them, all of these things. Now, these sound like things that somebody might want to do, but the rules do not allow for them. You cannot be a director for life because they can always remove you. You cannot fully protect yourself if you're in a minority because the majority has wide discretion in decisions that might affect you negatively. But what can you do instead? You can play around with all these rules to create a structure around you that might get you close to that outcome. A director for life you cannot be, but hey, keep the majority of the shares for yourself. Majority of the shares for yourself. So in that case, you know that they cannot vote you out because you got control of an ordinary resolution. You're in a minority position and you feel a little bit threatened. Why not have those shares of yours, even if you've got just a small percentage, 5-10%, why not put them in a special class? Because if they're in a special class, then you might be in a minority in the whole company, in the general meeting, but you are a majority within your own class. And the rules provide for consent mechanisms from the class itself when you're trying to change their rights. We've got the list of things where general meeting is absolutely required, and that includes stuff like shutting down the place. If you want to wind up the company because you decided you would finish it and take your money and go someplace else, this is something that obviously requires the consent of the general meeting. But then you've got all these things that come with corporate governance. Again, if they're only applicable to public companies in the stock market. If you want to appoint auditors, certain transactions that the directors might want to get in, for instance, taking advantage of a corporate opportunity or investing in something related to the company or doing certain actions with their own shares, these things might require, according to the code, general meeting approval, or to take certain defensive measures if somebody is trying to buy up the company. Again, these require approval. So these are all things that are coming, a softer source of law because they're coming from the code, but they're also things that you need to be aware of. Plus, you need to be aware of various thresholds that are sort of security mechanisms that are built into the rules for public companies. You find some of those in the Companies Act, some of these in the Corporate Governance Code, many of those in the listing rules. For instance, if a company is trying to engage in a transaction that is of a very significant size, because of the elevated risk that this represents for the value of the company, then you need to get approval from the shareholders. This is some of the latest stuff that's been introduced in the system to stop overtly ambitious executives from doing great deals, the kind of stuff that somebody goes abroad and buys a foreign bank and says, we've become the biggest bank in Europe, wah! And in fact, they bought somebody that's really terrible and carries a lot of liability, and then the whole group goes bust. So this is precisely the kind of horrible stuff that these rules are trying to prevent. If the general meeting says, oh yeah, let's go buy everybody, then that's their problem, because that's their money. You don't really want to leave, okay, maybe not exactly with banking, because this has then significant effects across the economy, but at least they're voting to lose their own money. You don't want the executives to be able to make those decisions purely on their own. How do people make this within the meeting? You've got the provisions for the votes. Most of these votes are taking place in writing, so you get this impression from the movies that everybody kind of gets into a theater and they start kind of waving hands around. This is not really how it works. For smaller private limited companies, pretty much everything is done in writing. For most of the stuff that you have in public companies as well, it happens in writing. You have a little opportunity for people to physically get together. And you will find, if you go through section 281 that talks about the, and you go through the relevant sections in your textbook, you're going to see what does it mean for them to vote and how they vote. 282 is about ordinary resolutions, 283 is about special resolutions, and you get all the general rules. One crucial thing to remember is that we make frequent analogies between a democratic process and voting at general meeting. Remember that voting at general meeting most of the time is voting how many shares they've got, not how many people are there. Sometimes you have a hand, you're taking a poll of the people present in the room. What is the percentage? And it gives you an idea about how people feel about things. But kind of stuff need to be by a vote, and a vote is the vote of this. So it could be all of you guys, you've got 5 shares each, and I've got 5,000. So obviously, my view matters a lot more. This is where the parallel with the democratic process down, right? Because it's not one shareholder opinion is not of equal value to the other shareholder. It matters they actually have. For you to think a little bit about an activist shareholder, these are the people who help companies innovate or change their management by coming in and saying, you have the power to remove your board, you have the power to change how the company is changed. If what is stopping you is the lack of an alternative, here's the alternative. So usually you get people who buy a small amount of shares, enough to give them the right to bring things to a vote or make representations, and then they come in and present a new team. And they say, the current board of directors has not been managing things effectively. Here's my new team. Get those people out, get us in, and we're going to do great stuff. So this usually, if you're Googling around the idea of activist shareholders, you're going to find information on this. In a way, a source for good. The stuff that they do once they take over most of the time are not great. Cost cutting and firing a lot of people. And the idea of putting some pressure on the board so the board is kind of awake and switched on and is trying to achieve the best stuff, having somebody kind of chasing after you makes you more active. That is a good thing all in. One of the most famous guys involved on this is Khan, who is famous in the US as an activist shareholder. He's a guy with a lot of money who kind of can buy the shares and can come in and agitate for these changes of direction.